BurgerFi, the once promising fast casual burger chain, has filed for bankruptcy. This news has sent shockwaves through the industry, leaving many to wonder how such a popular brand could fall so quickly. This shocking news came as a surprise to many. Just a few years ago, BurgerFi was expanding rapidly, opening new locations and gaining a loyal customer base. Just weeks ago, the company warned investors about its future. The warning signs were there, but few expected the situation to deteriorate so quickly. Now, BurgerFi is seeking Chapter 11 protection. This move is an attempt to restructure its debts and hopefully emerge stronger. It's a stark reminder of the tough realities facing the restaurant industry today. High operational costs, fierce competition, and changing consumer preferences have created a perfect storm. This isn't an isolated incident. The pandemic has accelerated many of these challenges, forcing even well-established brands to rethink their strategies. Other chains, like Red Lobster and Buca di Beppo, have also faced similar struggles. These brands, once household names, are now fighting to stay relevant in a rapidly changing market. The restaurant sector is grappling with changing consumer habits and economic uncertainty. More people are opting for delivery and takeout, and economic pressures are causing consumers to tighten their belts. BurgerFi's story is a cautionary tale of ambition meeting a challenging market. It serves as a reminder that even the most promising ventures can face unexpected hurdles. BurgerFi burst onto the scene in 2011. Its promise? To revolutionize the fast food industry with a focus on quality, to elevate the humble burger to gourmet status. The company focused on fresh, all-natural ingredients and a customizable menu, allowing customers to craft their perfect burger. It quickly gained a loyal following, with customers flocking to experience the better burger concept. In 2020, BurgerFi went public through a SPAC, a special purpose acquisition company, aiming to capitalize on its growing popularity. This move was meant to fuel rapid growth and expand its footprint across the nation. The company even acquired Anthony's coal-fired pizza and wings, expanding its reach into the pizza and wings market. However, this acquisition added significant debt to BurgerFi's balance sheet, creating financial strain. The pressure was on to perform, and the company struggled to keep up with the high expectations and financial burdens. The once promising rise of BurgerFi faced significant challenges, leading to a stumble in its journey to dominate the fast food industry. BurgerFi's bankruptcy filing reveals a stark financial reality. The once promising burger chain, known for its gourmet offerings and eco-friendly practices, is now facing a financial crisis of monumental proportions. The company has liabilities between $100 million and $500 million. This staggering amount of debt has put immense pressure on the company's ability to operate and meet its financial obligations. Its assets, a mere $50 million to $75 million. This significant disparity between assets and liabilities highlights the precarious position BurgerFi finds itself in. This gap is a clear indicator of the severity of their financial troubles. The financial health of the company has been deteriorating over the past few years, leading to this critical juncture. The first quarter of 2024 painted a bleak picture. The company's financial performance has been underwhelming, with key metrics showing a downward trend. BurgerFi reported a net loss of $6.5 million. This loss is a significant blow to the company's financial stability and has raised concerns among investors and stakeholders. This, despite generating $42.9 million in revenue. While the revenue figures might seem impressive at first glance, they are overshadowed by the company's inability to manage its expenses effectively. Clearly, the company was struggling to translate sales into profit. The profit margins have been razor-thin, making it difficult for BurgerFi to sustain its operations and invest in future growth. Expenses were high, and the company's ambitious expansion plans were backfiring. The costs associated with opening new locations and maintaining existing ones have been draining the company's resources, leaving it vulnerable to financial instability. BurgerFi's struggles aren't unique. The entire restaurant industry is facing strong headwinds. Consumers are tightening their belts, and dining out is often the first expense to go. Rising interest rates and inflation have also squeezed profit margins for restaurants. The labor market has also posed challenges. Finding and retaining staff has become increasingly difficult. This has led to increased labor costs, further impacting profitability. BurgerFi, like many others, found itself caught in this perfect storm. Section 5. The numbers tell the story. A key metric for the restaurant industry is same-store sales. This figure tracks sales at locations open for at least a year. It's a crucial indicator of a company's health. Unfortunately for BurgerFi, this metric told a troubling story. BurgerFi's same-store sales plummeted by 13% in the first quarter of 2024. This decline, coupled with mounting debt and losses, signaled a company in crisis. The bankruptcy filing, while shocking, seemed almost inevitable in hindsight. Section 6, franchisees left in limbo. BurgerFi's bankruptcy filing has significant implications for its franchisees. These independent operators invested heavily in the brand, hoping to capitalize on its popularity. Now they face an uncertain future. Will they need to rebrand? Will they be able to negotiate more favorable terms with a new owner? These are just some of the questions weighing heavily on franchisees. The bankruptcy process will likely be complex and could take months or even years to resolve. Section 7. The future of fast casual, a shifting landscape. BurgerFi's downfall is a symptom of a larger trend. The fast casual restaurant segment, once a beacon of growth, is facing an inflection point. Consumers are becoming more discerning, demanding both quality and value. Chains that fail to adapt risk sharing BurgerFi's fate. Innovation, menu flexibility, and a strong digital presence are now essential for survival. The fast casual landscape is evolving, and only the most adaptable will thrive. Section 8. Stay tuned. The story isn't over. BurgerFi's bankruptcy filing is just the beginning of a new chapter. The company will likely be sold either in whole or in parts. What will become of the brand? Will a new owner be able to revive its fortunes? The restaurant industry is watching closely. This story is far from over. Stay tuned for further updates as the situation develops.